Welcome back, everyone. Let's continue and learn about key definitions with regard to depreciation. The first definition is expenses. Expenses are outflow of cash or other valuable assets from a person or company to another person or company. Labor costs, interest on money borrowed, rent, maintenance costs, operating costs. These are all different forms of expenses. And those are part of the deductions that are available for taxpayers. And then we have assets. Assets are expenditure in which the benefit is not exhausted within the current year, but is enjoyed over a long period of time. So assets in simple words is the machine purchases, houses, vehicles, equipments, anything that you buy for your business. That is called an asset. An asset, unlike expenses, you don't use them within a year or so. You're going to use them over time and benefit from them. And what you can do with your assets is you can receive tax credit, but is not deducted all at once, but over time through depreciation. So for example, if you buy a vehicle for your business and that vehicle costs $10,000, the first year that you bought it, you cannot deduct $10,000 from your income. What you can do is you can deduct $10,000 over, let's say, 5 years that you're going to use that truck. And every year you're going to deduct a little bit of that $10,000. And every year, what you're doing is you're calling or you're claiming the depreciation of that truck, and you're receiving tax credit for that. And that is depreciation. So formally speaking, depreciation is decrease in the value of an asset based on age, use, or output. So imagine that you have a business with so many different assets. You're going to use depreciation accounting to spread the cost of a depreciable item over multiple years. And every year you're going to deduct a little bit of that asset's value from your gross income. And depreciation, this is very important, depreciation is not a cash flow, but it impacts the taxes that are paid, which are cash flows. So it's not itself is not a cash flow, but it impacts the cash flow. Different types of depreciation. We have physical depreciation and we have functional depreciation. Physical depreciation are with respect to physical, wear and tear, corrosion, rotting, wear and tear from use. These physical depreciation typically lead to higher maintenance costs for the business owner. And we also have functional depreciation, such as obsolescence, declining need for services, inability to meet increased quality or quantity requirements. And these are more functional depreciation that you can still use to reduce your taxable income. Types of depreciable assets. What type of assets you can claim for their depreciation? Some of them are tangible, such as buildings, machinery, equipment, vehicles. Those are very tangible. But there are some intangible and depreciable assets, such as patents, software. A very important point here is that land is not depreciable. So if you are opening up a business and you're purchasing a piece of land, that land and the money that you paid for the land cannot be used for depreciation purposes. That leads us to this question that which assets can be depreciated? Well, based on U.S. tax law, asset must be used in business or held for production of income, or asset must have a definite service life at least 1 year in length. Also, it has to be something that wears out, decays, gets used up, or loses value from natural causes. So if your asset falls into that category, it's most likely that you can claim for their depreciation. Now, let's talk about very important depreciation terminologies here. The first one is cost basis, and cost basis is the taxpayer investment, essentially the purchase price plus improvement, additions, or any installation cost. It's essentially the cost of the asset that you're buying. And you're going to depreciate that over time. That initial cost is called cost basis. Then we have depreciation deduction. That is the amount of depreciation that you're going to claim for every year. So every year you're going to have a different depreciation deduction. And while you're depreciating the asset, the under-depreciated portion of an asset, the portion that is not depreciated yet, is called book value. So let's say if you have a truck that you bought for $5,000, the first year you apply for, let's say, $1,000 of that. So the $4,000 remaining that is not depreciated yet is called the book value of that truck after the first year. Then the time over which we're going to depreciate that asset is called depreciable life. And then after the depreciation is over, you're going to have a salvage value for that asset. That is the estimated market value at the end of the asset's useful life. And then we have useful life. That is the estimate of duration of use for the asset. And I want to point out here something important, the difference between depreciable life and useful life. Depreciable life is typically shorter than useful life. Depreciable life can be 5 years for a vehicle, but you're going to use the vehicle for more than 5 years. That is the useful life of the vehicle. But depreciable life was much shorter, it was 5 years, meaning that you can depreciate the entire investment that you made for the vehicle over 5 years, which was the depreciable life, but you're probably going to use that vehicle for a longer period of time. That is the useful life. So let's put everything in perspective using this graph. So here in this graph, we can see the cost basis. And cost basis is shown with B here. And here on the y-axis, we have the dollar value, and on the x-axis, we have time. The cost basis is the initial cost of the asset. Let's say that is $10,000. And you can see that this graph shows how this asset depreciates over time. And looks like the depreciable life is 5 years. So over 5 years, the cost basis of $10,000 reaches to the salvage value of, let's say, $1,000, right? So you were able to depreciate 9,000 here. The depreciable life is shown with N. The salvage value is shown with S. And then every year, you're going to apply for a certain depreciation deduction. For example, in the first year, this is the amount of depreciation deduction. So this is D1. And when you claimed for the first year depreciation, at the end of year 1, your asset has this value, right? Let's say, I don't know, $8,500. And this is called book value at the end of year 1. So this is book value 1. And every year, you're going to apply for more deduction, and your book value goes down, and your depreciation deduction changes until you get to the 5th year, where you depreciate your asset fully, and you reach to the salvage value. We're going to be talking about different depreciation methods. We'll be starting with straight line depreciation, which is the simplest depreciation method, and then we will move on to declining balance depreciation and more.